Nifty 500 Value 50 Index Fund. If you are someone who believes in value investing and wants to invest in fundamentally strong companies, then this fund could be on your radar. That's why we are going to analyze whether investing in this fund will be worth it in the long run or not. Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to take the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this fund, let us first understand a few basic details about this fund. So, as an NFO, it opens on 4th October 2024 and closes on 18th October 2024. And some of the key features of this fund is it is an open-ended fund type which belongs to the category of equity value oriented, and it has Nifty 500 Value 50 TRI as its benchmark index. And there is an exit load of 0.25% for redemption within 15 days, while there is no entry load for this fund. And the minimum investment amount you need to start investing in this fund is just 100 rupees. And the fund managers for this fund are Mr. Hitesh Das and Mr. Karthik Kumar. And according to the riskometer, the risk involved in this fund is very high. Now, if you take a look at the investment objective of this fund, you will understand that the primary investment objective of this fund is to provide returns that before expenses closely correspond to the total returns of the securities as represented by the underlying index, but as an index fund, it will be subjected to tracking error as well. So, this is the primary investment objective of this fund. Now, as we have a basic understanding about this fund, let us now understand the index that it is representing, which is the Nifty 500 Value 50 Index. So, this index consists of 50 companies from its parent Nifty 500 index, which is selected based on their value score. So, the value score for each company is determined based on earnings to price ratio, book value to price ratio, sales to price ratio, and as well as the dividend yield. And this index can be used for a variety of purposes such as benchmarking and creation of index funds, ETFs, and other structured products. Now, let's take a look at the sectors this index represents, which are oil, gas, and consumable fuels, financial services sector, metals and mining, power, chemicals, construction materials, services, and construction sector. So, the highest weightage of 28.25% is given to the oil, gas, and consumable fuel sector, while the lowest weightage of 0.90% is given to the construction sector. Now, if you take a look at the top 10 holdings of this index, then you will find out there are the top 10 holdings of this index are Oil and Natural Gas Corporation Limited, NTPC Limited, Coal India Limited, Grasim Industries Limited, Vedanta Limited, Power Grid Corporation of India Limited, Hindalco Industries Limited, State Bank of India, Indian Oil Corporation Limited, Tata Steel Limited. So, the top first position is given to the Oil and Natural Gas Corporation Limited by a weightage of 5.87%, while the top 10th position is given to the Tata Steel Limited by a weightage of 4.12%. Now, as we have taken a look at all these, now let's move on to the data gathered from the tabular column, as you can see, and from the index, that the index returns as on August 30, 2024. According to this graph and the tabular column, that we can see in 1 year it has produced a return of 86.59%, and in 5 years it has produced a return of 37.78%, and since inception it has produced a return of 18.15%. And in the graph also we can understand that in short term it has a lot of dips here and there, but if you look at it in the overall bigger picture, in long term it has consistently performed well, especially as you can see from 2020 it has a good hike. So, this index return shows us that it is good for long-term performance, especially compared to the short-term performance of this index. Now, as we have a basic understanding about this fund as well as the index it is representing, now let's move on to analyzing whether this will fit our investment portfolio or not by analyzing the pros and cons of investing in this fund. So, let's start with the positives. As you can see, there are 4 main key advantages in this fund. One is focus on the value stocks. So, this fund follows the Nifty 500 Value 50 Index, which means it picks 50 of the top value stocks from the broader Nifty 500 universe. So, these are companies that are considered undervalued, potentially offering long-term growth at a lower price. Another advantage is the diversification across sectors. So the fund provides sectoral diversification by investing in multiple industries, reducing the risk associated with any single sector while keeping exposure to fundamentally sound companies. The third advantage is the lower cost passive strategy. So since this is an index fund, it follows a passive strategy. This leads to a lower expense ratio compared to actively managed fund, making it a cost effective way to get exposure to value stocks. And finally, the final advantage, as you can see, is the long term outperformance potential. So historically, value stocks tend to outperform growth stocks over the long term, especially during market recoveries. So this makes the fund a potential option for investors with a long term horizon. So these are some of the advantages of this fund. Now, if you take a look at the disadvantages, there are also 4 other potential drawbacks. As you can see, number 1 is the slow growth potential. So value stocks are known for being undervalued, but that can mean slower growth. If you're looking for quick returns as a short-term investor, then this fund might not meet your expectations because it's more suitable to patient and long-term investors. And another potential drawback is that there is no flexibility in the stock selection, because as a passive fund, it strictly follows the Nifty500 Value 50 index. So there is no active management to take advantage of the short-term market opportunities or mitigate risk during downturn period. Number 3, it can also underperform in bull market. So during strong bull markets, growth stocks typically outperform value stocks. This means the Axis Nifty 500 Value 50 Index Fund may underperform compared to funds that focus on growth or momentum during such periods. Another major potential drawback is the market dependent performance in this fund. So since this fund tracks an index, the performance is entirely market dependent. If value stocks are out of favor, then the fund's returns might not look appealing. These are some of the potential drawbacks as well as the potential risk you might be undertaking while choosing to invest in this fund. So deeply explore all these factors before deciding to invest. What is the final takeaway from our analysis? Is investing in the Axis Nifty 500 Value 50 Index Fund worth it or not? As you can see, this offers a low-cost, diversified way to invest in undervalued stocks with the potential for long-term gain. But remember, it's better suited for patient investors who can ride out slower growth and market volatility. So it completely depends on what kind of investor you are and what kind of time horizon you want to achieve your investment and financial goals. So it completely depends on up to you. It's completely depends up to you. But our personal opinion is that if this fund might be suitable for an ultra conservative investor who's not willing to invest in an actively managed fund. But even then, there are similar index funds out there in the market that has a lower expense ratio as well as a lower tracking error. So if you do want to invest in an index fund, invest in a fund which has a lower expense ratio and a lower tracking error. But even then, if you're an investor who's an aggressive investor and you want to take a lot more risk and you want your fund's performance to outperform the market and you want dynamic fund allocation in your investments, then all these factors can be found in an actively managed fund where it can even has the potential to deliver higher returns than an index fund like this. So if you want these factors in your investment, it's better to consider an actively managed fund than an index fund. And finally, if you do have some doubts regarding whether investing in this will be suitable to you or not, as you do not have the time or to research about this fund, or you do want professional guidance on deciding investments for your main investment portfolio, then you can definitely consider consulting with a certified financial planner who will look at the suitability of the investment objective, risk profile, overlap ratio, and allocation you can give to a fund you are interested in, and see if it all aligns with your investment portfolio and your goals, especially, so that they make your investment journey simplified and hassle-free process for you, which can especially be helpful for you in the long run. So consulting with a certified financial planner and seeking professional guidance can be more beneficial for you in the long run.
And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.